And the build out of AI is at least temporarily inflationary. When you're fighting over power, you're ironically fighting over like Chinese parts, like transformers, to get the power into the type it needs to be and all that. That's inflationary. Replenishing missiles is inflationary. So building out all this physical stuff is kind of temporary inflationary, and that's coming before we've really seen a lot of the deflationary impacts. But yeah, in the longer run, this is a productivity boost. And I think that at least the Fed chair is kind of considering that. I mean, like you said, that was one of his narratives for a while, and I think it still is. If he's looking for ways to be dovish, that's the narrative that they're probably going to latch on to, which is that we expect tech deflation. So even if we have these other inflationary areas, maybe we can not be as hawkish.
The next inflation shock may not come from oil, wages, or a central bank printing press. It could come from something far more surprising: the race to build the machines that are supposed to make everything cheaper. Artificial intelligence is demanding enormous amounts of electricity, data centers, transformers, chips, cooling systems, and physical infrastructure. And while the world is still waiting for AI's productivity gains to show up across the economy, the spending required to build the AI economy is already showing up in prices. That creates a strange economic paradox. We are building a technology that could eventually produce more output with fewer workers, lower operating costs, and dramatically higher productivity. But before that deflationary force arrives, companies and governments have to spend enormous amounts of money actually building the infrastructure. Power grids have to expand, data centers have to be constructed, equipment has to be manufactured. Even military replenishment is adding to the demand for physical resources. In other words, the road to technological deflation may run straight through an inflationary construction boom. And that puts the Federal Reserve in a particularly difficult position. If inflation remains sticky because of energy, geopolitics, fiscal spending, and this enormous physical build-out, the Fed has reasons to remain cautious. But if AI productivity starts spreading through the economy at the same time, the inflation picture could change much faster than traditional economic models anticipate. Lyn Alden argues that this tension is already becoming important, and it could determine how policymakers respond to the next phase of the economic cycle. In this video, we'll look at why Alden believes the Fed is becoming less dependent on forward guidance, why the balance sheet could continue expanding even under a supposedly hawkish chairman, and why AI could ultimately become one of the most powerful deflationary forces the global economy has ever seen. If you want more deep dives into the forces reshaping markets and the global economy, hit like, subscribe, and turn on post notifications so you don't miss the next video. And let me know in the comments, do you think AI will become inflationary before it becomes deflationary?
The short answer is that, to some extent, he's trying to not be super clear because, and this is part where I would agree with the new chairman on, is that when the Fed is just always giving information about what it's going to do, it's like it's almost like the tail wagging the dog. And so they're just doing less forward guidance in general. And they make a decision, and they give some degree of expectation of what they're going to do, but then they just make decisions. The market just has to work around those decisions. So they're just always trying to manage the exact thing that they're going to do. In general, the Fed has a tendency to look through energy-driven inflation because their tools are mainly around getting banks to lend more or getting banks to lend less. There's less they can do about fiscal dominance. There's less they can do about oil shocks. And their kind of tools are somewhat limited. So when you have rapid money supply growth and that's contributing to inflation, they look at that and say, well, let's try to raise interest rates to slow down bank lending and make housing more restrictive and all that. Warsh is already on the record right now saying that the housing market is restrictive. Obviously, inflation is still above target. They're watching the Middle East. That's where you get that energy risk. Right now, money supply growth in the U.S. is not above average. It's kind of in the ballpark of average. The issue is they really don't have the deflationary offsets, that they don't have the globalization offset that they did for a long time. They don't have like the other offsets. I mean, the Middle East war is not helping the inflation situation. It's kind of this recent bump. So what Warsh might have done if you had this kind of Schrodinger's outcome of what if we didn't attack Iran, what would Warsh have done over this kind of first year in office versus what is he going to do now, because we have these higher sticky inflation prints because you have energy inflation. My general assumption that he's kind of neutral to slightly hawkish for a bit. where he's not looking to cut right now because you have above target inflation. Um, but and inflation is now off of its official year-over-year highs. So May was a higher year-over-year print than June. That might reverse if the Strait of Hormuz stays closed again. So we'll have to see what happens when we get July and August figures in and all that. But I think right now is in more of the credibility building phase. And they've reiterated that they want to get inflation down. So I think in the near term, it's kind of signaling that they're not going to be super hawkish, but that they're kind of leaning toward neutral to maybe a hike or two here, depending on what happens with some of this other stuff. But I wouldn't expect much more than that on the hawkish side. On the balance sheet side, I've been in the gradual print camp really since kind of autumn of last year, which is that the balance sheet stopped going down. They kind of ran into their functional limit, not their absolute limit of how much they can reduce the balance sheet under current kind of bank regulatory conditions, but they got pretty close. They're now gradually increasing it. As a base case, I expect that to continue. Just gradually expanding the base money supply. Now, Warsh has historically been a hawk on the balance sheet ever since 2011 because he's actually been on the Fed before. He wasn't the chairman, but he's been on the Fed before, and he's been a hawk on the balance sheet. Now, some of his remarks recently have actually been kind of dovish on that, which he's like, okay, I'm a hawk, but we're gonna, it's a committee. We're gonna make sure banking partners are well aware of what we're gonna do. We're not gonna surprise markets. Everything's gonna be so. He's easing the market to make sure that they know he's not like an ideologue on this. And so I think that they're gonna make tweaks around the margins to, maybe all else being equal. I think he'll probably grow the balance sheet slower than Powell would have, which already would have been slow in my view, at least in this kind of post 2025 and present and forward environment. And most of the tools he has at his disposal is to try to find ways to get banks to hold more treasuries. So it's like you're almost like you're doing QE either on the central bank side or the commercial bank side by kind of easing their restrictions to let them circulate their existing liquidity a little bit more, get a little bit more fractional reserve in there. And so I think that he's more likely to have, say, a flat to up balance sheet. And I still kind of lean toward the mildly up direction.
Alden's description of the Fed's approach points toward an important shift. Markets may have to stop expecting policymakers to constantly preview their next move. Instead, investors increasingly have to interpret the data and react to decisions after they happen. And with inflation still above target, but money supply growth no longer exceptionally strong, the Fed has a complicated balancing act, particularly when energy shocks and geopolitical events are largely outside its control. But there is another piece of this puzzle that could matter even more: the balance sheet. Alden has been in the gradual print camp, arguing that the Fed has effectively reached the limits of how far it can shrink its balance sheet under the current banking system. If that process has already stopped and the balance sheet begins gradually moving higher, the monetary backdrop could look very different from what the market expects.
Yeah, I'm on the record in like my reports where I was like, Warsh is not going to be a puppet in that kind of more direct sense. Like, I think partially where the market got that concern was Stephen Myron, who was appointed for a period of time. He came in with like dovish outlier dot plot stuff. Like, the whole the rest of the Fed would be in one direction. He'd be like the super dove. And I wouldn't necessarily he made his own case for rates, and he had a case before he was appointed and after, and it was what it was. He wrote that paper on trade, which was I think a pretty good paper. So it's not to throw him under the bus, but he was just objectively an outlier compared to the rest of the Fed on rate policy. So I think some part of the market thought that, but I think that Warsh is more of like the Secretary Treasury Besant type pick. Besant pick, not necessarily like a Trump pick per se. So it's kind of like that camp of the administration. There's always kind of multiple camps within an administration. I think this is more of like the camp that kind of was like, you need a credible guy in here to run this and make sure that markets feel like it's credible. So I think that's the direction they went in. I think also Trump picks people like this that have a TV, they have a reasonable charisma score. They're not bad on television. Because it does in some ways reflect the administration in a visual sense. So I think the combination of he got the approval of kind of his finance guys is really not someone that anyone would object to. on from just like from it with inside the industry, like inside the banking industry, inside this, there's really no one saying that this is not a qualified candidate. So, um, yeah, I think that it's possible that he'll get aggressive toward him, but I think it's just going to be kind of business as usual with the Fed for a while. And if he does get aggressive toward him, I think they're going to kind of just shrug it off and just kind of just tunnel vision on. We're trying to get rates get industry inflation down. We're trying to XYZ, and they're just going to kind of tunnel vision, kind of like how Powell was doing it for most of the end. They're just kind of almost pretending certain attacks aren't happening.
Do you think there's a risk of the Fed still assuming that we're in an old world when the world is actually changing faster than they'll be able to react to?
I mean, I think that to the extent that you get faster than average deflation, I think they're always able to cut, and they're always able to print. The harder, it's always harder for them to stop high inflation than it is to reinvigorate inflation, especially with the fiscal situation is what it is. I also think that the worst, they're kind of on record, at least the chairman is saying that, I mean, they are paying attention to momentum, which is that if you have inflation that's above target but falling, that's a signal versus just what is the number right now, right? So I think they are looking at that, and so all technology is basically, well, most technology is deflationary. There are certain periods of time where you have like a Cambrian explosion of technology, which is more deflationary than other times, either in tech like stagnates for a period of time. And so, for example, late 1800s in the U.S., like when you had just railroads and electrification and just all this stuff kind of hitting around the same time, that this industrialization, electrification, everything, and eventually factories in the early kind of 20th century, that was just a massively deflationary time from a technology standpoint. And then you have other periods like in post-war Japan. You just had this massive productivity boom, just this very organized tech-focused situation that was just massively deflationary in a good way. And right now China is a deflationary force because they built out all this excess industrial capacity, so they're able to just spin out cheap and increasingly reasonably quality cars, which is a very deflationary force. Like here in Egypt, my background's different because I'm in Egypt right now. The over every year, the percentage of Chinese cars on the road is going up, and it's partially because Egypt has this very inflationary money situation. So the number of hours it takes an Egyptian to buy like a Volkswagen compared to 5 years ago is generally more hours. So a Volkswagen's more out of reach than it was 5 years ago for many families here. Same thing for a Hyundai. Hyundai was pretty popular here and still is. But the rise of Chinese cars comes along and says, hey, you can get a similar quality for half the price, 2/3 of the price. And 5 years ago, it might have been, the quality difference would have been bigger, and over time, the same thing happened when Hyundai, for example, hit the market. It's like, that's the cheap one, and after around they go through a couple reps, and now they're actually decent cars. Chinese cars have done that, so that's a deflationary force in a good way. It says, okay, you might not be able to buy that Volkswagen for the same number of hours, but with the same number of hours, you can buy a Chinese equivalent, which is 90% as good in some case, depending on what model you're looking at. And so, yeah, you have that kind of periods of time where you have more rapid tech deflation. And I think AI is that right now. Now, the interesting thing is it's not yet really showing up in the broad data, right? So on an anecdotal scale, I mean, I know there's I'm in the venture space, so I see how our portfolio companies are implementing AI and how much they can do more with less. I see other businesses from other verticals say, we're hiring so much slower because just like our legal bills are way lower. Like it solves this, it solves this, it solves this. The amount of code we can write per employee just like exploded, but it's not showing up in like nationwide data yet. And like that, I think that goes back to many companies are still pretty slow adopters, not in terms of say giving the equivalent of ChatGPT to their employees, but in terms of how do we actually run our business leaner. There's still a really big percentage of the economy that hasn't gone through that funnel yet. And the build out of AI is at least temporarily inflationary. I mean, when you're fighting over power and you're ironically fighting over like Chinese parts, like transformers, to get the power into the type it needs to be and all that, and so that's inflationary. Replenishing missiles is inflationary. Building out all this physical stuff is kind of temporary inflationary, and that's coming before we've really seen a lot of the deflationary impacts. But yeah, in the longer run, this is a productivity boost. And I think that at least the Fed chair is kind of considering that. I mean, like you said, that was one of his narratives for a while, and I think it still is. If he's looking for ways to be dovish, that's the narrative that they're probably going to latch on to, which is that we expect tech deflation. So even if we have these other inflationary areas, maybe we can not be as hawkish as they I think a lot of times they do try to find ways to be a little bit on the dovish side.
Technology has always had the potential to push prices lower by allowing society to produce more with fewer resources. But Alden points out that these effects don't arrive evenly. There can be periods when technological innovation accelerates dramatically, creating an enormous wave of productivity and falling costs. The late 19th and early 20th centuries provide one example, with electrification, railroads and industrialization transforming what the economy could produce. Japan's post-war productivity boom provides another. And today, China's industrial expansion has created its own powerful deflationary pressure by flooding global markets with increasingly competitive goods. AI could represent the next major acceleration. The remarkable part is that the productivity gains are already visible at the company level, even if they haven't fully appeared in the headline economic statistics. Businesses are discovering that AI can reduce legal expenses, accelerate software development, automate routine work, and allow smaller teams to accomplish tasks that previously required significantly more labor. But the economy hasn't completely reorganized itself around these capabilities yet. And that may be the most important part of Alden's thesis. The inflationary phase of AI could arrive before the deflationary phase. First comes the enormous physical investment: electricity, transformers, data centers, chips, networks, and all the infrastructure required to support an AI-powered economy. That creates demand for scarce physical resources. But once that infrastructure exists and adoption spreads through businesses, the equation can start to reverse. Suddenly, the same technology that required massive amounts of capital to build can begin reducing the amount of labor and resources required to produce everything else. That creates a fascinating problem for central bankers. Imagine inflation remaining stubborn while AI investment is accelerating. The Fed could interpret the inflation as evidence that monetary policy needs to remain restrictive. But underneath the headline numbers, businesses could simultaneously be becoming dramatically more productive. If those productivity gains eventually accelerate enough, inflation could fall faster than traditional models expect. And Alden's point is that the Fed may actually be watching for this possibility. If policymakers need a reason to become less hawkish without completely abandoning their inflation-fighting credibility, technological deflation provides a compelling argument. They can acknowledge that inflation remains above target, while also arguing that accelerating productivity could help bring future price pressures down. And that creates a strange economic sequence: inflation to build the future, followed by deflation once the future arrives. If you enjoyed this breakdown, make sure to hit the like button, subscribe to the channel, and share this video with someone who follows Bitcoin, macroeconomics, AI, or the global economy. Thanks for watching, and I'll see you in the next video.